Welcome to Financial Planning Explained. I'm your host, Mike Menninger, Certified Financial Planner, owner and founder of Menninger Associates Financial Planning. I'm pleased to have Kyle Ryan join me, another Certified Financial Planner of the firm. What we're doing today, backed by popular demand, so to speak, is another case study. We do these case studies simply because of the fact that whenever we come across certain ones that have a lot of moving parts, it basically enables us to create talking points on a whole boatload of the things. Now, mind you, this isn't a real person, but at the same time, we're not providing specific recommendations, but what we may be referencing, strategies, ideas, kind of drawing a fine line between making recommendations. But the whole premise of this is to utilize a particular case study for the sake of discussion, because half the problem with coming up with these ideas is what to talk about. Every once in a while, we got somebody who comes in and all of a sudden like, wow, look at all these different things we can talk about. And they're real life. Yeah. So let's start off. We had a couple of people come in, and this is common, and you've probably had this before. They come in with ideas and goals of these things, and when you start digging in, all of a sudden it opens up all kinds of different cans of worms where we almost forgot what we're talking about, or there's just so much more to it. And this was a perfect example of it.
And before we even jump in, it's one of those things, we come across people, no one has a simple situation, right? Everyone's got moving parts, but when we come across something where we talk about tax planning and it comes into your estate plan, it impacts your retirement plan, impacts your cash flow, these are the areas where we want to compile everything we can together, because it's not just about understanding one topic, it's about understanding flexibility and how decisions today can impact multiple varying avenues in the future.
Absolutely. It's not even in the future. Certain things that you do today impact other things today.
Yeah,
and if there's any one thing of the 6 areas of financial planning, you got cash management, tax planning, risk management, which is insurance planning, investment planning, retirement planning, and estate planning. They are all integrated, but if there's any one that is, it's the tax planning piece. So, no matter what you do in any of those areas, it has a tax impact. And the tax impact could be today or it could be down the pike. So anyway, these folks called us up pretty much out of the blue. They had seen us because we write a lot of articles in magazines. And this may have been triggered by an article that we wrote on taxes. We wrote a couple of them in the beginning of the year, approaching April, and lo and behold, they called us up and said, we have to pay too much taxes. We need help. Yep. So what they say, we have a big tax bill, or we had a big tax bill. We weren't expecting it. Don't understand why, et cetera, et cetera. We're looking for help. And, while we're at it, can you help us improve our tax efficiency? And they also said, we've got a lot of debt. We're looking to try to reduce it, manage it, et cetera, et cetera. And oh, by the way, we also want to plan for retirement. Well, these are pretty much what everybody always says.
Some big hitters there.
I know, but everybody says the same thing. It's like, I want to make as much money as I can.
Yeah.
Oh, okay.
I want to take as little risk as possible, make as much as I can.
Right, exactly. That's a standard.
Retire yesterday.
So, generally speaking, the first thing we do whenever we're gathering information about a client is, you can bounce back and forth as goals and objectives, and they pretty much laid it out on a table. But then we just gather basic information about them. And what I always like to say is, we'll get their balance sheet. Okay, their names, their age, their date of births, their children. It gives us a sense of, where they are in life. If you're dealing with somebody in their 30s, is entirely different than dealing with somebody in their 50s or their 60s, because the demographics make a lot of sense.
Yeah, and one of the easy questions to do that is just asking people, what does money mean to you? Because what money means to you at certain points in your life changes rapidly. For me, it's a matter of living right now for me, right? For some people, it's a matter of, how much of an impact can I leave on this earth when I'm gone? What can I leave behind for people? Can I just retire and live comfortably and bleed it all out to zero? So, and all those things change as you go through the stages of life.
Absolutely. Absolutely. So in this particular case, we had a couple, both of them age 52. Okay. Roy makes about $160,000 salary. However, he also gets bonuses, RSUs, restricted stock units, which we could talk about. Gets stock options. He gets all kinds of other stuff on top of it because he works for a large corporation that gives that type of thing. His wife is self-employed. Okay, now looking at just last year's tax return, She had a profit of $80,000 that she put on her tax return. And there we asked, do you have children? Yes, we have 2 children. They're both adults, independently living. And as they said, and I've heard this, they're off the payroll. Okay. They're never really off the payroll. Just from someone who has adult children who are off the payroll, they're never entirely off the payroll. But long and short of it is that they don't have specific dependents. They're done with school. They don't have student loans that they're responsible for. They have 2 adult independent children.
Yep.
So then went in, asked them about their assets. All right, they have a $450,000 home. Roy has a current 401k with his current employer of about $600,000, specifically traditional 401k. We talk about the difference between traditional and Roth 401k.
Yep.
Traditional is pre-tax, Roth is after-tax. And I know this particular company, it's a large company in the area. We have several clients who work for this company, and I know this company does offer the Roth.
Yep.
But everybody, especially those people in their 50s and 60s, have been sort of trained all these years. Oh, obviously you want to take a tax deduction because you're making $200 and something thousand a year.
Yep.
Because when you're retired, you're not making anything.
Yep.
So obviously you're in a lower tax bracket, right?
And using the pre-tax 401k as that example, right? Like if I'm making 200, take the tax deduction, don't pay the tax on it today is the traditional rule of thumb.
Right.
Pay it in retirement when I'm not working, but there's things have changed, right?
That's conventional thinking.
Conventional thinking.
And we've had several episodes on this specific topic. It's in reverse. Ironically, it's really driven by 2 main points. Number one, we're in the lowest income tax bracket system that we have ever been in, and it's scheduled to change in 2 years. And then number 2 is, somewhere a little better than 30 years ago, the government changed how they tax Social Security. It used to be that Social Security wasn't taxed. Now it is. It's taxed based upon your other income. So therefore, all these contributions you're making to your 401k at a low income tax bracket, you're going to find yourself paying a higher tax later. Not everyone, but certainly a lot of the people that we deal with.
Yeah, and they're in their 50s, right? A lot of these people, they've had 401ks for 30 odd years. The Roth 401k has not been around for 30 odd years. Yeah, so they're going to have a large balance in the pre-tax. And then when it came around, the 401k, it's a large corporation, maybe it was introduced 10 plus years ago. It still goes back to the conventional thinking, why would I pay the taxes today? So we come across people with $1 million plus 401ks, multiple $100,000 401ks all the time. And while we're in the same tax brackets we're saying almost the same thing to most of them, is why are you taking this tax deduction today? Because it's a very lesser known rule.
Almost certainly going to be in a higher income tax bracket later. And it's really driven, again, mostly because of the tax brackets today. The tax brackets today are the lowest they've ever been. So, all right, what else did we find out? So, and Roy also has an old 401k with about $400,000, also traditional, okay, and found out later, once he provided us with a copy of the statement, that it actually showed it, that out of his old 401k, he had $90,000 worth of stock in there. And then, which you don't usually see on the statement, but it actually showed his cost basis.
Of the company stock.
Of the company stock. Good point.
Very important.
Good point. We're going to talk about the specifics of this because there's a little known rule called net unrealized appreciation. And we've had episodes on it before, or an episode just on it, or we've talked about it in different episodes.
It's certainly worthy of it, and we've done it, of an entire episode itself. That's probably something we'll circle back to, so that we can talk about it in more depth. We just want to get through the facts, at least to start here.
Right, and to continue on, we'll talk more about the NUA. And then Kim has a $100,000 SEP IRA that she's currently contributing to. And then Roy, going back to him, he also happens to have, and thanks for pointing this out earlier when we were looking at this, he has $40,000 of additional company stock, but that's unaffiliated with his 401k. It just so happens that he accumulated the stock with the old company with RSUs and employee stock purchase program. He has $40,000 in company stock.
And something that a lot of people might be aware of, but most aren't, is what a SEP IRA is as well. We mentioned Kim has a $100,000 SEP IRA. It's essentially It's a sister program almost to a 401k. It's very commonly used for people who are self-employed, where you are the sole business owner or you're married to the other 50% business owner. So SEP IRA is a simplified employee pension. So I just wanted to explain that it works the same way as a pre-tax 401k in most circumstances.
Well, the big difference is that the SEP IRA is typically for self-employed people, and whatever they can contribute up to 20% of their income, of their profit.
Yep.
The problem is that if they have employees, whatever they contribute to themselves, they have to contribute to the employees.
Yes. Yep.
So, if they're going to do 20%, well, they got another employee making 50 grand.
Yep.
Now all of a sudden they have to contribute 10 grand or 20% of 50 grand to the employee. Well, that was not the intent.
Yep.
And she's self-employed.
And ultimately, again, it's a pre-tax account. Sort of what we're getting into, that they have a lot of pre-tax assets built up.
Right.
Which is the opposite of what we're trying to get to in terms of tax planning.
That's correct. So if you take a look at what we've got here, we've got basically $1.1 million in pre-tax assets. Yep. Okay. They're both 52 years old and they're pounding away at their 401ks. So if we were to project out in the future, that 1.1 million in 10 years is going to be over 2.
Yep. Okay.
Plus all of the money that they're contributing to, they're going to have a very sizable pre-tax, you never want to belittle $2 million.
No,
it's a beautiful thing.
It's pre-tax or after tax, $2 million is $2 million.
Right. Except that if they don't like paying taxes now, it's not going to be the happy dance in April every year at their house. Okay. So anyway, so that's the basis of what their assets. Now let's talk about their debts. So their home, we said, was what, $450,000? And they have about $125,000 mortgage at a beautiful 3%.
Yep.
They have a home equity line of credit for $100,000, and that's at prime. Prime, moving target. Yep. Whenever you hear the federal government say we're raising or lowering interest rates, the moment they do that, boom, your line of credit rate changes. Yep. Well, several years ago, it was a beautiful thing. When it was at 3.5%, it was a lovely thing. Yep. Now it's 8.5%. Not so lovely.
And it's hurting you. Yeah.
But it certainly raised a question that had me concerned. Like, how'd you come up with a $100,000 line of credit? Yeah. Because there are a lot of solutions to taking a line of credit and doing something with it, whether terming it out, meaning making it even, 8.5% is kind of high. But most importantly, I asked them the question, how did you get a $100,000 line of credit? It's kind of a lot. And I'll tell you, the concern that I had, and I'm sure you've had this happen before, that you help someone clean up their debt, you meet with them a year or two later, poof, all their debt's back again, and they cleaned it up, which means they're spenders.
Yep.
So combined with the fact that they had some credit card debt, they had 2 car loans, I was point blank with them. I said, how did you arrive at that debt on your line of credit? And he said, we did all kinds of additions on the house. We built the garage, we built the addition and everything else. It was about $130,000, $140,000, and we've been trying to pay it down. I said, okay, that's fine. It's not as if
one-off expenses, but that's what they say about one-off expenses is every year you have a big one-off expense, and all of a sudden you have to start budgeting for that.
It was different, and in this particular instance, I felt comfortable that it was a legitimate use of the line of credit. And what he also said, but when I did it, it was at 3%. And I'm like, yeah, how are you feeling about your monthly payments today? He said, yeah, he says, that's what's killing us.
Yep.
With the rise in interest rates that the government put through over the course of 2022 into 2023, it took the line of credit and made what used to be a really nice loan to now it's eating them alive.
And that's the difference of things like a home equity line of credit, which is what's referred to as a variable interest rate, goes up and down, versus at the time, maybe hindsight's 2020, but maybe you should have taken out a home equity loan, because that's a fixed interest rate. So maybe that would have came out at 5.5. But you never know that you can't plan for these things when you meet with them after the fact.
Right. That's correct. That's correct. Hindsight is 20/20, they say.
Yeah.
Exactly. Yeah. So closing out, and then we'll take a break. They've got a car loan. They have 2 different car loans. One that's $20,000 at 7%. The other one's $9,000 at 6.5%. Call it middle of the road rates.
Yeah.
But they have about $15,000 on their credit card, and that's at 22%. Obviously, that's something that makes no sense, because if you think about it, that's almost $300 a month just in interest that they're paying.
Just an interest. And, you kind of look at that and it's an immediate place to add value, right? If you have that amount in savings, you can say, well, it's nice and easy. You can wipe this off. Oh, you're concerned about not having enough in savings. Well, look, you still have a credit card line of credit that you can tap into.
Right.
Better yet, what is your home equity line of credit? Line of credit, right? Because if it's at $100,000, you're at the limit. You can't really use that anymore. If your home equity line of credit's at $200,000, do you want to pay 8.5% interest or 22? I'll let you pick.
Yeah, right. That's an easy one. So what we're going to do is we're going to come back and we'll be with you in just a few moments as we take a break.
Do you keep up regularly with your investments? Where exactly are your hard-earned dollars going? Are you financially prepared for an emergency?
I'm Mike Menninger, founder of Menninger Associates Financial Planning. We believe that education and knowledge are powerful, and we want our clients to understand why we are making the recommendations that we make. It's your money, and you deserve to know where it's going, because it's not how much you make, it's how much you keep. So call us today to discuss your financial concerns. Welcome back to Financial Planning Explained. Mike Menninger with Kyle, and what we're doing is we're going through a case study. What we did is in the first segment, we talked about what their goals were when they came in, and then we kind of got through some of the facts where we were looking at their ages and their children's ages, and then we looked at what their assets are, what their debts are, and now that we gathered all that, what we're going to do is circle back around and come back to what were their goals of when they came in. And so we take a look at their goals, and they said, we want to avoid a big tax bill in April. Let me share a little bit more about that. And we're going to talk more about self-employment later and the tax impact, but they basically weren't putting money away for the taxes.
Yep.
Duh. You're making $80,000 in income. They were, but not enough.
Yeah.
Okay. It makes $80,000. No wonder you got a large tax bill,
If you're
because
not paying much into it, you're gonna.
we're going to be talking about it later. But your tax on that $80,000 is about 40%.
Yeah.
And that's not a small number. 40% of $80,000, you got a $30,000 tax bill at the end of the year. It's no wonder. And what I don't get, and I'm not here to pick on accountants, I'm not actually sure if they do their taxes or not. But if they have an accountant doing their taxes, which I believe they do, why isn't the accountant saying something to them?
There's got to be a step up in service once you have a self-employed individual, because W-2 is more straightforward. Whether you like it or not, you're going to have taxes withheld for the most part from a W-2 job.
Right.
It kind of sorts itself out. There's nuances where it doesn't.
Right.
But self-employed, unless you have an accountant who's right there on top of it for you, you're left on your own. You're like, okay, I made $80,000 in profit last year. This year, I'll send in, and then you're doing this. You're doing your best.
Well, where I've seen that before is people who have extraordinarily variable
income
years.
Yeah, of course.
So one year they might make $50,000, next year they're making $150,000, next year's $20,000, and the next year's $200,000.
Yep.
That you can understand. Not having enough into the system because you don't really know.
Yep.
But what we did is we sat down with them, which is really important, is people don't understand the tax system.
Yeah.
And it's really not that hard.
I love when you say that.
I know,
Yeah.
because, but anyway. So what we did is we took the time to explain to them how the tax system works so that they better understand how to address it. And, so avoiding the tax bill, we're going to talk about it later, but there's a handful of ways. You need to get money into the system.
Yep.
It's that simple. A tax bill in April, I see them blaming the accountants. I see them blaming everybody else. But the reality of the situation is, this is your tax. If you pay $10,000 less into the system, you're going to owe $10,000.
Yep.
It's that simple.
Yep.
And if this is your tax and you put $10,000 more, you're going to get a $10,000 refund.
Yep.
It's that simple. So if you have a giant tax bill at the end of the year, the odds are you're not putting enough in.
I don't quite have an issue with having a tax bill per se at the end of the year. I have an issue when there is the word penalty.
Right, that's
involved.
correct.
Because if you owe 40 and you pay 30 and you owe 10 and there's no penalty, you would have paid that 10 anyway. You
Right.
just kept that money in your pocket a little bit longer. You avoided giving the IRS an interest-free loan.
That's correct.
Penalties are where you run into trouble. And we see it all the time where people come in and they're like, I paid a couple $100, doesn't matter.
Hey,
I haven't met someone who has said no to a free couple $100.
that's right. That's right. Yeah, it's one thing. Now, I actually will say there are people who strategically know they're underpaying
Yep.
because as a business owner, they realize cash flow is more important to the business.
Yeah.
And they've used it for that. But most people aren't even aware. In fact, most people aren't even aware that there's a penalty. And if you wanted to see if there's a penalty, you look at the very last line on page 2 of the tax return or page 3 of its 1040 SR.
Yep. For the senior.
It's bigger font
Yep.
for the senior. Right, exactly. Because for those when your arms aren't long enough.
Yeah, you gotta get
All right,
glasses.
my arms are getting there. But penalty is stupid money. I
Yep.
mean, it's one thing to pay the tax. A penalty, unless you knowingly are going into it, to your point, it's stupid money.
Yeah.
But nobody likes surprises in April. And if you're really doing tax planning is both short-term and long-term. Short-term tax planning involves making sure that the government is getting the appropriate amount to A, avoid penalty, and B, to make sure that you don't have big surprises in April. Nobody likes surprises.
Yep.
Okay. So
When you kind of back it up though, so when we look at the goals, because we come across this often, right? You get a call from a new prospective client in April or May, chances are it's about taxes of some sort, right? So they came in with really 2 tax objectives. They want to lower the tax bill and increase tax efficiency. They sound very similar, but when you really peel it back, they're 2 very different things. Having a low tax bill gets down to withholding enough taxes so that you're not met with a surprise of 10, 20, 30 grand that you have to pay in April at that time. Tax efficiency, at the end of the day, I believe is what most people are seeking.
Right.
In terms of, yes, I'll get enough into the tax system to avoid penalty, but what I'm really seeking is tax planning. What can I do today to lower my tax bill either today or in the future? And that's where a lot of times we differ with accountants is, someone comes in, I want to contribute to my pre-tax 401k or a SEP IRA so I can lower my tax bill
it's
today.
short-sighted.
But where
That's-
we are is looking at tax efficiency over your lifetime. If we know you're paying 20% today and 24% in the future, take your tax deduction today. Or pay the tax
Right.
today so you never have to pay that higher rate. And that's where tax efficiency is different than just getting enough into the system and lowering your overall tax bill.
There's also an extra layer of tax efficiency where we're going to talk about in the next episode when we get deeper into the self-employment.
Yes.
It was amazing too that they weren't taking all their expenses.
Yeah, that's,
Right?
Yep.
That's not tax efficiency, that's tax stupidity. But that's a separate issue. Okay? But again,
Yep.
education and knowledge are powerful. They weren't aware of certain things that they were allowed to take as deductions
Yeah.
as a self-employed individual, which is a business owner. A business owner has legitimate deductions that they can take. Take them.
It's as easy as that. Yeah. If it's open, what's the saying? Those who know the rules of the game tend to play it better.
That is correct.
Yeah.
That is correct, and I always say that all the time. So we'll talk about some of the tax efficiencies as well in the next episode. And then the other thing is they wanted to reduce or manage their debt. And again, getting down to the basis of it is debt has a tendency to not only be wasted money on interest, but it has an emotional weight on people's shoulders.
If I have learned anything since becoming a financial advisor is the psychological impact of debt. A lot of times people would rather give up. There can be a black and white decision. We've had this conversation.
Oh yeah, because I'm doing.
I can earn 5% at the bank, or I can overpay my 3% mortgage. There's black and white finance, which says earn more interest, you're better off, and then you can later overpay your mortgage. Where you're earning 5, don't pay off your mortgage at 3. Then there's the emotional side of it, where it says, well, I can earn that extra 2%, but I don't want a mortgage. I don't want a mortgage, and that's the ultimate goal. And I've had people where I don't care. I will overpay my mortgage because I don't want that debt.
I'm one of them.
Yeah, I know.
And you know
I
what?
tell you every time.
I know. And by the way, the difference between, because the 5% that I'm earning on my money market, by the time I get done paying taxes, is only about 1% higher than my mortgage.
Yep.
And while I know it's better, it'll just be nice to not have a mortgage. I've never, well, since I've owned a house, I've never been mortgage free.
Yeah.
It'll be a cool thing to, have.
Yeah. I'm looking forward to losing that status.
Yeah, right. Exactly. Exactly. And then planning for retirement. That was another goal of theirs. And we find this often, and we are going to spend more time on the planning for retirement. And we'll touch upon it as well. But in this particular instance, sometimes you find yourself when you're meeting with folks that you kill off the biggest and closest fire. And when I looked at their situation, I mean, heck, with the amount of debt that they have, okay, you figure $100,000 at 8.5%, they're spending $8,500 a year in interest there.
Yep.
22% of $15,000 is another what? $3,300 in interest there. Then now they're at 11.8 plus the car loans. They're paying $1,000, not even including their mortgage. They're paying $1,000 a month just in interest on their debt. And that's a lot.
It is. And that's a big part of planning for retirement. And, even subsequently to that, if they come in and they say, hey, I've got these debts, but I have this big chunk of assets. Do I have enough to retire? And it's the same part as the debt pay down side. It's, you can have $1 million, you can have $500,000, $5 million. It does not matter how much you have. It matters how much you're spending on the back end, how much
That's correct.
for expenses. Because you could have $1 million, you're spending $30,000 a month. It's not going to last you very long. It's not enough. Whereas, it goes both ways. But that's why even when they came in, they said, I want to plan for retirement. Well, what does retirement look like for you? They're like, do I have enough for it? Goes to this debt pay down. You need less when you have less debt.
And sometimes, too, in their case, like, well, I need to be contributing 15% to my 401k. I'm like, okay, well, you're contributing 15% to your 401k, which is wonderful. But number one, if you back that down and contribute something to 22% credit card, that 22% is after tax. Yep. Okay? You have to earn almost 30% rate of return to net out 22.
Yep. I'd take that. I'd take the credit card deal.
Right, exactly. So, all right, that's the statement of facts. And what we're going to do in the next episode is we'll re-bring up some of these, but then we'll start talking about nifty, cool strategies, ideas, things that they could do to help accomplish their goals and improve their financial situation. So stay tuned. We look forward to seeing you on the next episode of Financial Planning Explained. And thank you very much for tuning in. See you next week.